Welcome to This Explainer. Today we're diving straight into a massive financial shift that's quietly completely reshaping the global economy. We're dropping right into a situation of sheer scale. You know, the kind of situation most people completely ignore right up until it starts affecting their daily lives.
Right now, the United States government owes more than $40 trillion. That's trillion with a T. It's a number so ridiculously large that our brains just aren't wired to process it, so honestly, most of us just kind of stop thinking about it. And frankly, for years, the exact size of this giant debt pile didn't really matter. Why? Because investors around the world were always willing to lend America more money.
But lately, something kind of strange is happening. For the first time in decades, investors are starting to ask a question that used to be considered absolutely ridiculous. They're asking, what if lending money to the United States just isn't the safest bet in the world anymore? Now let's be crystal clear right up front here. We are not predicting the collapse of America. The government isn't packing its bags and leaving tomorrow morning. But we are reading a very real, very changing message from the bond market. And it's a message that investors, economists, and central banks are watching incredibly carefully.
Okay, let's move into section 1, the $40 trillion question. Who exactly is going to buy all this debt?
See, for a really long time, this massive debt just wasn't an issue simply because the world always wanted to buy it. Whenever the government needed money, they borrowed it, and there was always a willing buyer waiting in the wings. These traditional buyers were massive and highly reliable. Pension funds bought the debt, foreign governments bought the debt, banks bought the debt. Absolutely everyone wanted US Treasury Bonds. But here is the core dilemma we're unpacking today. America just keeps creating more debt than ever before, and these exact reliable buyers, well, they're slowly starting to walk away.
Okay, let's dive into this with section 2, how America borrows money, specifically by issuing treasury bonds. To really understand why this matters, we kind of have to look past that common myth of the government just printing money whenever it needs cash. That's not how it works. They issue bonds. You probably know the basic mechanics. You give them cash today, you earn interest over time, and your principal gets paid back years later at maturity. For decades, this system worked beautifully. Treasuries essentially became the closest thing finance had to a completely risk-free asset. And because there were just so many eager buyers, America's borrowing costs stayed incredibly painlessly low. But here is the catch. The debt has exploded from single-digit trillions back in the early 2000s to over 40 trillion today. Think of it like this. Imagine you're carrying a huge credit card balance. Now imagine every couple of years, that balance comes due, and you literally need to take out a brand new loan just to replace the old loan. That is basically what governments do. They have to continuously issue new bonds just to fund their current spending and to refinance the old debt that's already coming due. The only real difference here is the scale. We are talking about rolling over trillions of dollars every single year. That brings us to section 3, a shift in global demand. Because those reliable buyers, they're changing their habits. The reality is, the financial world of 10 years ago just doesn't exist anymore. Back in the 2000s, foreign governments were easily some of the largest buyers of US debt. Countries like China and Japan accumulated massive treasury holdings. In fact, the entire global financial system pretty much revolved around recycling dollars straight back into US bonds. And this brilliantly illustrates the shift to today's reality. Those flows have changed. China has significantly reduced its holdings from its peak levels. Other countries, they're actively diversifying their reserves. Some central banks are stacking up on gold, while others are purchasing totally different assets altogether. Now, they still own a lot of treasury bonds for sure, but that trend of relentless guaranteed buying, yeah, that's pretty much broken. The absolute crucial point here boils down to basic math. The United States government isn't borrowing less money, it is borrowing much, much more. So, if foreign demand weakens right when the supply of bonds continues exploding, well, basic economics takes the wheel. Bond prices fall, and their yields, meaning the interest rate the government actually has to pay out, rise. And that is exactly what we've been seeing, with long-term borrowing costs climbing pretty dramatically compared to that ultra-low rate environment we all got so used to.
Moving right along to section 4, the math of rising yields. Let's look at why this debt isn't free.
Borrowing all this money is never free, and the real-world pain of these higher rates is super easy to visualize. Just imagine taking out a mortgage at 2%. Awesome, right? Now imagine refinancing that exact same house for the exact same loan amount at 7%. Suddenly, your monthly payment is vastly larger. While governments face this exact same reality. As their older debt matures, it has to be refinanced at newer, significantly higher rates, which means the government's interest expenses are literally exploding. In fact, America is increasingly having to borrow money just to pay the interest on the money it already borrowed.
A lot of people just assume higher yields are a good thing because, hey, investors earn more, right? But there is a massive ripple effect here. Treasury yields directly influence absolutely everything in the broader economy. When government yields rise, your mortgage rates go up, auto loans get more expensive, student loans cost more, corporate borrowing costs jump, and private credit gets completely squeezed. It basically inflates your daily micro-borrowing costs across the board. Everyone pays more. And when money becomes that much more expensive, overall economic growth tends to slow down. It's a nasty feedback loop, and you better believe markets are noticing.
Let's look at the bigger picture in Section 5, the price of confidence, making long-term bets. So why exactly are investors suddenly demanding these higher yields in the first place? Well, because when you buy a 30-year Treasury bond, you aren't just locking in a simple interest rate. You are making a massive, very long-term bet. You are essentially saying, I trust what America will look like 3 full decades from now. These long-term yields are measuring confidence. They are the literal mathematical price tag of investor confidence in America's fiscal policy, its ability to control inflation, and its future economic stability across 30 years of unpredictable political decisions and economic changes. And recently, that confidence has simply become a lot more expensive.
There's this kind of brutal reality in the financial world. Stocks tell stories, but bonds do math. And math has a very funny way of completely ignoring narratives. Every single treasury auction is a test. Politicians can tell investors everything is fine, they can promise deficits won't matter, they can argue that future growth will solve everything, but eventually the numbers just have to work. Bonds are deeply skeptical by nature, and right now, the math is pointing out some very real concerns about deficits, entitlement spending, and interest expenses that just keep growing and growing.
Now, let's take a breath and keep things in perspective. Does this mean America is doomed? No, absolutely not. Not even close. The US still possesses the world's most important currency, the deepest capital markets, the absolute strongest financial infrastructure, and the largest economy on Earth. These are unmatched superpowers. Investors aren't debating whether America survives. The United States can absolutely continue borrowing. What they are debating, however, is what price they're actually willing to lend their money at.
And that brings us to the core realization of this explainer. The era of zero interest rate, cheap money, it's officially over. The truth is, America's debt problem isn't a full-blown debt crisis just yet, but it is definitely a severe borrowing cost problem. The global financial system is still adjusting to a reality where risk is no longer priced at zero. And when the world's single largest borrower suddenly faces higher costs, those consequences don't just politely stay inside the bond market, they spread everywhere. Think about it. For generations, the world never really had to ask whether America could find buyers for its debt. The buyers were just always there. But as we wrap up today, I want to leave you with this provocative final thought. The real question going forward isn't if buyers exist, it's how much they are going to demand to keep buying. That single question about the true price of confidence, it could easily shape the future of the entire global economy for years to come. Thanks so much for joining me on this explainer, and remember, keep paying attention to the math.